Okay, hello everyone. Now in today's class, we're going to attempt our Mar-Jun 2024 question. And this question is GARNOD company. The following exhibits available on the left-hand side of the screen provide information relevant to the question. So let's see the exhibits. First exhibit is GARNOD company. Okay, let's read it. GARNOD company was established 12 years ago to provide courses for accountancy qualifications. So GARNOD seems to be a training college, right? That it was established 12 years ago to provide courses for accountancy qualification. Like we provide courses to you guys. So it was established 12 years ago to provide courses to accountancy qualification. A major reason for GARNOD's success has been that it has been quicker than its competitors to develop profitable e-learning course packages. Apart from its founders, GARNOD staff turnover has been quite rapid. Some staff have not stayed long either because they're ambitious staff who have made a contribution but sought career progression elsewhere, or because they have been quickly dismissed. Okay. So GARNOD was established 12 years ago to provide courses for accountancy qualification. Major reason for GARNOD's success has been that it has been quicker than its competitors to develop profitable e-learning course packages. So why they are successful? Because they were quicker than its competitors, did things more earlier than its competitors. Okay. And they develop profitable e-learning course packages. E-learning means online packages. Apart from its founders, GARNOD's staff turnover has been quite rapid. Turnover is high, staff are leaving. Some staff have not stayed long, either because they're ambitious staff who have made a contribution but sought career progression elsewhere, or because they have been dismissed. GARNOD was listed 3 years ago on its country stock market for smaller companies. It has since developed governance mechanisms in compliance with stock market regulations. Some of its non-executive directors and investors feels that the culture is still too informal for a listed company. Okay. GARNOD's EDs are looking to expand the company into new areas of training where there is potential of cross-selling courses and further opportunities for development of e-learning packages. GARNOD's board has identified two possible target companies, Pilsur and Matthew. So in these 4 paragraphs, the first paragraph says GARNOD was established 12 years ago to provide accountancy qualifications. The success was due to the fact that they are quicker than competitors. They develop e-learning packages. Staff turnover is very high. GARNOD was listed 3 years ago on stock market. Okay. And NEDs and investors feels culture is informal. EDs are looking to expand into new areas. Okay. Further opportunities. And GARNOD's board has identified 2 target companies, Pilsur and Matthew. Mario. Target companies means GARNOD's board identified 2 target companies, that these are our 2 target companies. Target company means they can buy those companies. Okay. So the first company is Pilsur company. So let's see the data of Pilsur company. Pilsur situation. Pilsur has offered classroom courses for legal qualifications and professional development courses in the areas of law, tax, and regulation for over 30 years. Pilsur is also listed on the smaller company stock exchange on which GARNOD is listed. For a long time, Pilsur was a leading company in the area of legal training, and its directors and some staff have been the company for almost of its life. The company has a well-defined management structure with seniority and classroom experience being important attributes required for promotion. However, in recent years, revenue and profit growth has been slower than GARNOD's because increased competition and Pilsur's failure to develop effective e-learning products. Following recent financial data relates to 2 companies. GARNOD company has 180 million shares of $1, Pilsur at 100 million shares. Share price 6 for GARNOD and 5.4 for Pilsur. Free cash flow to equity 60 million, 70 million. Okay. Additionally, Pilsur's equity beta is 1.4, asset beta is 1.2. And expected growth rate in Pilsur's free cash flow to equity is 1.5% per year. Risk-free rate 3.8%, premium 8%. GARNOD's finance director believes that the acquisition could generate annually 9 million of free cash flow synergies. So acquisition will generate annually 9 million synergies. The multiple of free cash flow to equity is 8 for GARNOD before the acquisition and can be assumed to decrease by 5% for the combined company. So multiple of FCF to equity is 8. Okay. And for GARNOD before acquisition, and can be assumed to increase by 5% for the combined company if acquisition takes place. Finance director believes Pilsur shareholders would at a minimum accept a premium of 14% on the current price of its shares. So finance director believes that Pilsur shareholders, you are planning to target Pilsur, buy Pilsur. So shareholders would accept a minimum premium of 14% on the current share price of its shares. So they want 14% premium on their share price. Although she thinks that the shares may be overvalued at the current share price and the free cash flow to equity valuation should be used instead, Garnod's board has set a target of 60% of the gains on acquisition accruing to its own shareholders. Now, finance director believes that shareholders would accept a minimum 14% premium on the current share price. So this is their current share price, 5.4. They are thinking that their shareholders would accept 14% premium. But the finance director also thinks that the shares may be overvalued at the current share price. This price may be overvalued. Free cash flow to equity valuation can be used, and board has set a target of 60% of gains on acquisition accruing to its own shareholders. Garnod, who is buying, it is saying that 60% of gains will go to our own shareholders. Defense strategies. Pilsur's company's directors are aware that Garnod may be interested in acquiring their company. The directors would not welcome a bid for Garnod, as they feel it would result in major changes to how the company operates, threaten their own jobs. Two possible defense strategies have been suggested if Garnod makes a bid for the company. One is seeking an alternative, more welcome bidder for Pilsur. Other is Pilsur making a counter offer to acquire Garnod. Remember, you have studied this in defense strategies in mergers and acquisitions, that Pilsur directors are aware that Garnod may be interested in acquiring their company. They don't want it. So they've suggested two defenses. First, more welcoming bidder, that if someone good bidder comes, then Pilsur goes away. Another is to make a counter offer to Pilsur. So things have gotten really interesting here. First paragraph, Garnod was established 12 years ago. Accountancy qualifications is leading its competitors through e-learning. 3 years ago, listed on the stock exchange, but the investor think culture is still informal. EDs are looking to expand the company. They've identified two targets, Pilsur and Mar-Jun. Now, Pilsur's data is like this, that it offers classroom courses for legal qualifications, professional development in law, tax regulation for 30 years. Listed on the smaller stock exchange, Pilsur was a leading company. Some staff have been for most of its life. Company has a well-defined management structure. Seniority and classroom experience are important. Recent years, revenue and growth have been slower. This is the data. And then finance director believes it can generate 9 million synergies. Multiple of FCF to equities, 8. Finance director believes shareholders want 14% premium, but they're still thinking the share price is overvalued. Pilsur doesn't want Garnod to bid, so they have two counter strategies. Okay. The other target is Mar-Jun. Mar-Jun company is an unlisted company which is smaller than Garnod company or Pilsur. Company was founded 5 years ago by husband and wife, Richard and Katie, who own 80% of its share capital between them. Company provides professional development training in areas such as management and personal skills, also training in legal requirements such as health and safety. Richard and Katie have recruited lecturers whom they feel will work with them and have given lecturers considerable autonomy in delivering courses and gaining new work. Board consists of Richard and Katie and 2 other lecturers, but in practice, Richard and Katie make all major decisions. Mar-Jun's revenues and profits have increased in the last 2 years at a greater percentage rate than either Garnod or Pilsur. Mar-Jun has developed a limited number of computer-based courses, but it has insufficient funds to develop significant in-house e-learning capabilities. Richard and Katie have indicated they are willing to discuss a bit with Garnod. So Pilsur was not too much interested, but Richard and Katie, the owners of Mar-Jun, they are interested in discussing a bit. Mar-Jun, owned by Richard and Katie, has seen significant growth. It has also developed computer-based courses, but the funds are limited, okay? And they have a good portfolio such as management, personal skills, legal requirement, health and safeties, okay? Have given lecturers autonomy as well, okay? So this ends all 3 scenarios. Scenario number 1, Garnod wants to acquire 2 companies, has 2 targets, Pilsur, Mar-Jun. Pilsur, very big company, okay, listed on the smaller stock exchange as well. FCF equity and stuff are given, okay. Their percentage revenue and profits is falling, and their board is also not welcoming a bit, okay. Mar-Jun, unlisted company owned by Richard Katie. Their profits have increased in the last 2 years, okay. They have developed similar number of computer-based courses, but it has had insufficient funds to develop significant in-house e-learning capabilities. Okay, they are welcoming the bid. Okay, let's move towards the requirement. Requirement A. Analyze the suitability of Pilsur and Mar-Jun as possible takeover targets for Garnod. So you need to analyze the suitability of Pilsur and Mar-Jun as possible takeover targets for Garnod. You just need to analyze whether Pilsur and Mar-Jun are suitable. No calculations are required for part A. No calculations are required. 6 marks. I just need to analyze, assess suitability of Pilsur and Mar-Jun, whether Pilsur and Mar-Jun are suitable for Garnod. If I discuss 3-4 points for Pilsur, 3-4 marks, 3-4 points for Mar-Jun on suitability, whether it's suitable or not, 3-4 marks, very easy requirement. So let's just analyze suitability of Pilsur and Mar-Jun as possible takeover targets. Okay. Let's just analyze the suitability of Pilsur first. You can write about both of them combined. You can discuss the suitability of Pilsur and Mar-Jun combined, but I am discussing them separately. It's a student's choice, my choice. Let's analyze suitability of Pilsur as possible takeover targets. Okay. So suitability of Pilsur as takeover targets. Pilsur has a 30-year-old history in professional courses, has a very experienced staff who has been with the company since most of its life. Has well-defined management structure, which makes it suitable for Garnod company. Okay, you need to analyze suitability of Pilsur and Mar-Jun. So I'm checking suitability of Pilsur for Garnod company. Okay, whether Pilsur is suitable or not. Okay, so Pilsur has a 30-year-old history, experienced staff, okay, well-defined management structure, which make it suitable. However, its revenue and profits growth is slow, and they have failed to develop effective e-learning products. Growth is slower, and they have failed to develop effective e-learning products. Plus, their directors also are not welcoming a bid and putting forward defense strategies which may make takeover difficult. Okay. So in analysis, a very good thing is to discuss both sides. Okay. Analyze the suitability of Pilsur for Garnod. So Pilsur may be suitable, long history, experienced staff, well-defined management. Okay. But there are some problems as well. It may be unsuitable because management are not willing, directors are not willing, revenue profit growth is slower. They fail to develop effective e-learning products. So I think for 3 marks, I have mentioned 3-4 points whether Pilsur is suitable or not. Okay. Mario. So suitability of Mario for GARNOD. Mario revenue and profit has grown at a faster rate than GARNOD and Pilsur company. They have also developed computer-based courses, and their owners also willing to discuss the bid, which makes it suitable for GARNOD. However, company does not possess a long history like Pilsur. And they seem to be dependent on lecturers to deliver courses and have given them autonomy, which may be slightly risky. Okay. So people sometimes tell that the question asks, analyze the suitability of Pilsur and Mario as possible takeover targets. I need to analyze whether Pilsur and Mario are suitable. So I have discussed possibilities, suitabilities of Pilsur, whether it's suitable. Some points suggest it's not suitable. Mario, it's suitable. Some points suggest not suitable. So students ask, you haven't taken any objective decision. That's the worst thing one student should do. That take a decision. Pilsur is good. Mario is good. No, the question didn't ask you to take decision, which is suitable. It just asks analyze the suitability. So in analyze, always discuss both points. You can write in the end, that's not obligatory. Overall, both companies have their pros and cons. So company must carefully decide which to choose. I have to stop my answer here. Otherwise, I have more points to discuss, like in acquiring Pilsur, you will have to face many difficulties because it's listed company. To take over it, you have to buy the shares from many investors, which may be a long process, whereas Mary, only two people own 80% shares. You just need to convince two people. This can also be written, but overall, I think we have drafted a good answer in suitability of Pilsur and Mario, that whether Pilsur and Mario is suitable or not. So we have written both positive and negative points. Okay, please copy this. Okay, so after doing this part A, let's move towards the next requirements. Okay. We have already done part A, analyze the suitability of Pilsur and Mario as possible takeover targets. So I discussed the suitability of Pilsur as well as Mario, pros and cons. Now B, 9 marks. B has 3 parts. Calculate the minimum price which Pilsur shareholders are expected to accept. Minimum price which Pilsur shareholders are expected to accept. Target price which GARNOD would pay based on FCF to equity valuation on the basis of 60% of gains from acquisition accruing to its shareholders. Third, the percentage of gains from acquisition which would accrue to GARNOD shareholders if GARNOD paid the minimum price which Pilsur shareholders are expected to accept based on free cash flow to equity valuation. Okay. Now, one important thing, no discussion is required for part B. There is no discussion required, so we just have to focus on the 3 calculative requirements. But doing all of them would be a bit tricky. That's why just focus what they're trying to ask. First, minimum price which Pilsur shareholders are expected to accept. Number 2, target price that GARNOD would pay based on FCF to equity valuation on the basis of 60% of gains from acquisition accruing to shareholders, and percentage gains from acquisition which would accrue to GARNOD shareholders. Okay, step by step. I think minimum price which Pilsur shareholders are expected to accept. Okay, target price which GARNOD would pay based on FCF to equity valuation on the basis of 60% gains, and percentage gain acquisition which accrue to GARNOD shareholders. Okay, if it paid the minimum price which Pilsur shareholders are expected to accept. Okay, so one thing is clear, all these requirements relate to Pilsur. So let's just read the Pilsur part again. Pilsur has offered classroom courses over 30 years. It is also listed on a stock exchange. Pilsur was a leading company has a well-defined management structure, and revenue and profit growth has been slower because of increased competition. Following recent financial data relates to 2 companies. So GARNOD, who is the acquirer, who's the buyer? Pilsur. We are acquiring this company, target company, number of shares, share price, okay, and free cash flow to equity, 60 million, 70 million. Okay, this is FCF to equity, right? So 80 million shares, share price is 6, free cash flow to equity 60 million, and Pilsur has 100 million shares, share price is 5.4, 70 million is the FCF to equity. Pilsur's equity beta is 1.4, asset beta 1.2, growth rate in FCF to equity is 1.5% per year. So growth rate is given, risk-free rate 3.8%, premium 8%. Okay, so if you want to find KE, it's very easy. RF plus RM minus RF, the premium into beta equity. Garnod's finance director believes that acquisition could generate annually 9 million of free cash flow synergies. So acquisition would result in 9 million synergies. Okay. The multiple of free cash flow to equity is 8 for Garnod. So multiple of FCF to equity for Garnod is 8. So multiple of FCF to equity is 8. 8 times. Value is 8 times free cash flow to equity. The multiple of FCF to equity is 8. For Garnod, that means Garnod is trading at a multiplied value of 8. Before acquisition can be assumed to increase by 5% for the combined company if acquisition takes place. So if acquisition takes place, then the multiple may increase by 5%. Okay, so it's currently 8. It may increase by 5%. So 5% means it may rise to 8.4. Finance director believes Pilsur shareholders would at a minimum accept a premium of 14% of the current price of its shares. So Pilsur shareholders would accept a premium of 14% of the current share price of the shares. Although she thinks shares may be overvalued and current share price, and that a free cash flow to equity valuation should be used instead. So finance director believes Pilsur shareholders would at a minimum accept a premium of 14% of the current share price of shares. So finance director believes that Pilsur shareholders would accept a premium 14% on current share price of its shares. Although she thinks shares may be overvalued at the current share price, and FCF to equity valuation should be used instead. So they think that they will expect a premium of 14% on the current share price, but they think it is overvalued. FCF to equity valuation should be used instead. Garnod's board has set a target of 60% of gains on acquisition accruing to its own shareholders. So Garnod's board, the buyer's board, says that 60% of the gains should be going to our own shareholders. Okay, so all of this is somewhat related to these paragraphs: number of shares, share price, FCF to equity, equity beta, risk-free rate, premium. Finance director believes acquisition may generate 9 million FCF synergies. Multiple of FCF to equity is 8 for Garnod. So Garnod is trading at 8 times FCF to equity, and it will increase by 5% if the acquisition takes place. Finance director believes Pilsur shareholders would minimum accept a premium of 14%. Although she thinks the shares may be overvalued the current share price. FCF to equity valuation should be used. Garnod board has set a target of 60%. Okay. Gains going to its own shareholders. So requirement is minimum price at which Pilsur shareholders are expected to accept. So first is minimum price Pilsur shareholders will accept. Okay, this is the first requirement. Minimum price Pilsur shareholders will accept. How to find this? Finance director believes Pilsur shareholders would, at a minimum, accept a premium of 14% on current share price of its shares. You got the answer. What is the minimum price Pilsur shareholders would accept? Pilsur shareholders would accept a premium of 14% on current share price. So what is the current share price of Pilsur? So this makes it 5.4 into 1.14, 6.156. Okay, so minimum price is equals to 6.156 per share into how many shares they have? 100 million shares. This is the minimum price Pilsur shareholders will accept. Okay, 615.6 million. Okay, so minimum price Pilsur shareholders will accept. So minimum price was they will accept minimum premium of what did it say? 14%. Okay, so if they're accepting a premium of 14%, that means they will accept 615.6 million. Okay, very easy. The target price which GARNOD would pay based on FCF valuation on the basis of 60% of gains from acquisition accruing to shareholders. So what GARNOD would pay based on FCF to equity valuation if 60% of gains will accrue to its own shareholders. Okay, now GARNOD would pay the price. See, finance director believes Pilsur shareholders would accept a premium of 14% on the current share price. Although she thinks shares may be overvalued at the current share price, and FCF to equity valuation should be used. Okay, so let's use FCF to equity valuation to find value of Pilsur. Okay, that's the thing that finance director believes Pilsur shareholders would accept a premium of 14% on current share price. So I told that what they will want for 14% premium, but she thinks shares may be overvalued at the current share price. FCF to equity valuation should be used. Okay, so she thinks FCF to equity valuation should be used. So let's find the value of Pilsur under FCF to equity valuation. Okay, now no need to write this, but you all know. It's just for your revision again. Under FCF to equity valuation, value is equals to present value of all future FCF discounted at K. Okay, under FCF to equity valuation, value is present value of all future FCF discounted at K. Sir, you could have also discounted at WACC. You are right. But here there is no chance to calculate WACC. I can only calculate K. No WACC data is given. Okay, can only find K, RF plus RM minus RF beta equity. So since K is given, I will find FCF to equity. And it's also saying FCF to equity, not FCF to company. So present value of all future FCF discounted at K. Okay, so first we need future FCF, present value of all future FCF, but first we need FCF, future FCF. So what about future FCF? Current FCF is given 70 million. Okay, growing at 1.5% per year. Okay, so it's not like that FCF of year 1, year 2, year 3, or 4 are given, and they are saying it will grow year 4 onwards at this percent per year. So I would have made 4 columns, 1, 2, 3, 4, then 5 to infinity. I have taught you multiple times if FCF is given and directly growth rate is 1.5% per year, that means future FCF is 1 to infinity. Okay. Okay. So future FCF 70 million is the FCF growing by 1.5%. Okay. Present value of future FCF. So you need to multiply by discount factor, that is K. Okay, and for that I have to find KE here. KE is RF 3.8 plus premium 8, 1.4 beta equity. This is premium RM minus RF beta equity. Okay. %15. Okay, so you have the K. You need value under FCF to equity because the finance directors clearly said that they will accept a premium of 14%. But she thinks share price is overvalued. FCF to equity valuation should be used. So I'm finding the value under FCF to equity. Present value of all future FCF discounted at K. Future FCF is 70 million, 1.5% growth. Had it been given FCF of year 170, year 272, year 373, and then growing, so I would have made 1, 2, 3, and 4 to infinity. But if FCF to equity, FCF is given and growing at 1.5%, I told you to make 1 to infinity. Okay, K is 15%. Okay, but how do you find discount factor of 1 to infinity? Okay, I've told you take the last discount factor. So last year is year 0. So the factor is 1 upon K minus G. So K is 15% minus G is 1.5%. Okay, so last discount factor, that is last discount factor. Last year is year 0, factor is 1 upon K 15% minus G 1.5%. Okay, so present value for future FCF is D13 into D14. Okay, and this present value of all future FCF is basically the value of company and free cash flow to equity method, 526.3 million. Because under this method, the present value of all future FCF is the value. So present value of all future FCF is 526.3 million. That's the value. Okay. Now, things from the scenario are a bit extracted that finance director believes Pilsur shareholders would at minimum accept a premium of 14% of the current share price. So what is the minimum price requirement? A, they're going to accept 15% premium of the share price. So 15% above 5.46.15600 million shares. Okay. Now the requirement is still a bit unclear, but I've gained majority marks that the target price which Garnod would pay based on FCF to equity valuation. So I've got the FCF to equity valuation on the basis of 60% of gains from acquisition accruing to its own shareholders. So what price Garnod would pay based on FCF valuation on the basis of 60% of gains from acquisition accruing to its shareholders? What is the price Garnod would pay? Again, go back here. Finance director believes Pilsur shareholders would minimum accept a premium of 14%. She thinks shares may be overvalued at the current share price and that FCF to equity valuation should be used. Garnod Bose has set a target of 60% of gains on acquisition accruing to its own shareholders. The target is 60% of the gains of acquisition should go to our own shareholders. Okay. This is the target, that 60% of the gains should go to our shareholders. Okay. And that's what the requirement is. What is the target price? This is the minimum price. Their shareholders will accept 14% premium. What is the target price which Garnod would pay based on FCF valuation on the basis 60% of gains should accrue to our own shareholders? Okay. Now pay attention to this. I have got the minimum price at which Pilsur shareholders are expected to accept. Okay. Target price which Garnod would pay based on FCF to equity valuation on the basis of 60% of gains from acquisition accruing to its shareholders. Okay. Now, FCF to equity valuation should be used. I have found the value in the FCF to equity valuation. Garnod board has set target of 60% of gains on acquisition accruing to its own shareholders. So the board's policy is to give 60% of gains on acquisition accruing to its own shareholders. So for that, you need to find, firstly, what are the gains on acquisition? Now we have found multiple times gains on acquisition. How do you find gains on acquisition? For gains on acquisition, it's a very simple thing. Combined company value less the buyers and seller value. GARNOD value, Pilsur value. Okay, to find gains on acquisition would be like this. It is also called additional value created, like we have done in some other questions. Okay, gain on acquisition, additional value created. It's just the combined value less individual values of buyer and seller, GARNOD and Pilsur. So what is the Pilsur value? Just found 526.3 million. Okay, GARNOD value. Okay, GARNOD value 6 per share into 80 million shares for 80 million. And you can also find value for 80 million like this. Multiple of FCF to equity is 8 for GARNOD before acquisition. So before acquisition, GARNOD is trading at multiplier of 8 of FCF to equity. So FCF to equity is 60. FCF to equity is 60. So multiplier of 8 to FCF to equity is 480. So either way, it's 480. 80 million shares into 6 per share, 480 million. Or it's trading at multiple of free cash flow to equity of 8 before acquisition. So free cash flow to equity is 60. If it's trading at a multiple of 8 to FCF to equity, this makes it 480 million. Okay, now combined company value. We only have one information about combined company. Okay, that is the multiple of FCF to equity is 8 for GARNOD before acquisition and can be assumed to increase by 5% for combined company if acquisition takes place. So combined company multiple of FCF to equity would become 8.4. It's 8 increased by 5%. So combined company multiple of FCF to equity would become 8.4. So see this working. Combined company will be trading at 5% more multiple of FCF to equity. So what is the FCF to equity of the combined company? Pay attention to this. FCF to equity of the combined company will be, because it's trading at multiple of FCF to equity, okay, which will increase by 5%. So I need to have FCF to equity of the combined company. So combined company FCF to equity would be 60 million buyer plus 70 million seller and 9 million free cash flow synergies. Okay, so FCF to equity of the combined company would be 60 plus 70 plus 9 million synergies, right? And the value is 8.4 multiple of FCF to equity. So this is the FCF to equity 139 multiple of 8.4. 8 was the multiple before acquisition, 8.4, 5% more. Okay, so this will make it 1,167.6 million, the combined company value, and the gain for acquisition, also called the additional value created, will be B20 minus B21 minus B22. This is the gain on acquisition. Okay, pay attention. How did I get the gain on acquisition? Okay, why I need to find gain on acquisition? Because my requirement is saying this. The target price which GARNOD would pay based on FCF equity valuation on the basis of 60% of gains from acquisition accruing to its shareholders. Okay. So I need gains from acquisition. Okay. Now, how do I get gains from acquisition? Gains from acquisition is the additional value created, combined value less individual buyer and seller values. Pilsur value is 526.3 million. Okay. How did it find it? Through FCF to equity valuation. Sir, why you didn't do it like this? 5.4 multiplied by number of shares? Because the finance director was saying that free cash flow to equity valuation should be used. And even the requirement was stated as this, that based on FCF to equity valuation. So I first found the FCF to equity valuation of Pilsur, present value of all future FCF 1 to infinity, discounted at K. Okay. Now, to find gains on acquisition, combined value less individual value. GARNOD value, I found it like this, 80 million into 6,480, or trading at multiple of FCF to equity of 8. multiple of FCF to equity of 8 means 8 times FCF to equity, 480 million. Okay. Pilsur value, Garnod value is gone, combined value. Now, combined companies multiple will increase by 5% of FCF to equity. So 8 increased by 5%, 8.4. The FCF to equity would become 8.4. FCF to equity. Okay, so 8.4 is the multiple. What will be the FCF to equity of the combined company? It's simply the buyers, sellers, and the synergy of equity. Okay, so this is the additional value created, and since Garnod wants 60% of this gain, $161.3 into 60%. $96.78 million for its own shareholders. Okay. Just give me a second. Garnod wants 60% of this gain for its own shareholders. It will pay 40% of gain to Pilsur shareholders. 161.3 into 40%. 64.52 million to Pilsur shareholder. So now go to the requirement. Target price which Garnod would pay on the basis of 60% of gains from acquisition accruing to its own shareholders. So Garnod will pay. What was the Pilsur value? 526.3 million plus this 40% gain, 64.52 million. That is total $590.82 million to Pilsur shareholders. That was what was your requirement was. Requirement 2. I will explain it again, don't worry. The thing was that firstly, the requirement asked you the minimum price which Pilsur shareholders are expected to accept. So what is the minimum price Pilsur shareholders are expected to accept? That's given. They will accept minimum 14% premium on the current share price. So current share price 5.4, 14% premium makes it 6.156 into 100 million shares. Okay. Now the next part was a bit tricky. Even though you only did FCF to equity, you would have still gained half marks, but I mean 3 to 4 marks out of 9. Only doing FCF to equity. This is a good strategy that if you don't understand the requirement, okay, the target price which Garnod would pay based on FCF to equity valuation, at least you understand this FCF to equity valuation. Find the value under FCF to equity valuation. You would gain 3, 4 marks even if you don't fulfill the requirement. So maybe out of these 9 marks, 2 marks for this. you don't understand this requirement, 3 marks for only this FCF to equity, you still get 5 marks even though you don't know the answer. However, since this is a practice class, minimum price which Pilsur shareholders are expected to accept, this is the minimum price. I think this was an easy requirement, 6.5.6 million. Now, the second requirement was a bit tricky. Target price which Garnod would pay based on FCF to equity valuation on the basis 60% of gains from acquisition accruing to its shareholders. That was Garnod's thinking, that it wants 60% of the gains from acquisition accruing to its own shareholder. So firstly, based on FCF to equity valuation, I found value of Pilsur. How did I find value of Pilsur? Present value of future FCF. So future FCF is 70 million current, 5%, 1.5% growth, 1 to infinity, future FCF, discount factor K, present value of FCF, 526.3 million. Okay. This is the value of equity under FCF method. Okay. And the minimum price they want is this 14% premium. What is Garnod willing to pay? Because it wants 60% of gains for its own shareholders. So let's see what are the gains of acquisition. Gains on acquisition, additional value is combined value less Garnod Pilsur value. Pilsur value is here. Garnod is 6 million, 6 per share, 80 million shares, or you can find through multiple. Combined value, the multiple is 8.4 of FCF to equity. So 8.4 of FCF to equity. So I found FCF to equity of the combined company by adding both and 9 million synergies. This is the combined value. Less individual values, I got gain on acquisition. Okay. And 60% Garnod was for its own shareholders. Okay. Balance 40% to pay for Pilsur. So how much it will pay to Pilsur? Obviously, the value of Pilsur, 526.3 million, it is willing to pay that. Plus, it is not willing to pay 14%. It is willing to keep 60% gains for its own shareholders, only giving them 40% gain, 64.52. So it will pay 526 million. And then this 40% gain, 590.82. Okay. So I think now it's clear. So you can please copy, then I can move towards the third part. So always try to get the maximum marks, like if in this requirement, minimum price was very easy. If you are not able to understand target price, which cannot pay based on FCF valuation, so you should first sound the FCF equity valuation and gain 2-3 marks. 60% of gains from acquisition accruing to shareholders. So 60% of the gains from acquisition should give you signal. You need gains from the acquisition. Gains from the acquisition is combined value plus individual Garnod and Pilsur value. Okay. So last thing, percentage gains from acquisition which would accrue to Garnod shareholders if Garnod paid the minimum price which Pilsur shareholders are expected to accept based on FCF to equity valuation. Now, this requirement is the percentage gains from acquisition which would accrue to Garnod shareholders if Garnod paid the minimum price which Pilsur shareholders are expected to accept. And what is the minimum price which Pilsur shareholders are expected to accept? This. 615.6 million. Okay, this is the minimum price Pilsur shareholders will accept. So it's asking, what is the gain that would accrue to Garnod if Garnod paid the minimum price which Pilsur shareholders are expected to accept? Okay, so it's a very simple requirement that what is the percentage gain which would accrue to Garnod shareholder that would come in Garnod shareholders basket. Garnod wants 60% gains. Garnod wants 60% gains for its old shareholders. Okay. And for that, they are willing to pay 590.82 million to Pilsur. But the question is, what is the gain that would come in Garnod shareholders' pocket if it paid the minimum price which Pilsur shareholders are expected to accept? Okay, so very easy. Combined company value is 1167.6 million, right? This is the combined company value, right? What is the gain Garnod shareholders would get if Garnod paid the minimum price which Pilsur shareholders are accepted? So this is the combined company value, Garnod value. $480 and Pilsur value. Okay. Sorry, Pilsur payment. So how much you are paying to Pilsur? The requirement is if Garnod paid the minimum price which Pilsur shareholders are expected to accept. So you paid them, let's suppose 615.6 million. The minimum price they will accept. So what is the gain left for Garnod shareholders? They got a company, combined company after acquisition, L7. Their own company was L8 and they paid L9 to Pilsur. So they got 72 million. They got how much? 72 million. Okay. And what is the percentage? Okay. They got 72 million gain out of total gain of 161.3. So that means their shareholders got a gain of 44.64%. I have one more way of computing this, but first understand the requirement. The requirement was percentage gain for acquisition, which would accrue to Garnod shareholders if they paid the minimum price which Pilsur shareholders want. If they paid the minimum price that Pilsur wanted, 615.6 million. So let's see their position. They paid them 615.6. Got a company having a value of 1167.6, but their own company value was 480. So 1167.6, they got their own company value was 480 and they paid 615.6. So they got 72 million, which is out of total gain, 161 million, 44.64%. I have one alternate way of calculating this as well. And if you like that way, you can do that. In the second part, 161.3 was the gain from acquisition. Garnod won 60% of their gain for its own shareholders. Okay, 96.78. And it won 60% of gains, 96.78. And it will pay 40% gain to Pilsur shareholders, that is 64.52. So they are going to pay 526.3 million plus 64.52 million, 590.82 million to Pilsur. This is part B, that they will pay 590.82 million. Now, instead of 590.82, okay, please pay attention. Another way, it's your choice. Instead of 590.82, according to part C, they paid what they demanded, 61.56. Okay. This means Garnod profit got reduced by, okay, instead of 590.82, they paid 61.5.6. So profit reduced by the difference, 24.78 million. So instead of getting what they were expecting, 60%, 96.78, they got 24.78 million less. That is 72 million. See, in this way also, you got 78 million. In this way also, you got 78 million. So it's your choice. Either you want to do this way, or it's your choice. Either you want to do this way. I'm just changing the colors so that, you know, that both are same things, but in different ways. Okay, 72 million getting. Requirement should be understood. Requirement is that percentage gain which would accrue to Garnod shareholders. What will Garnod shareholders want? 60%. That's written everywhere in the question, that Garnod shareholders want 60% of the gains. And in that case, they have to pay 526 million was the value of Pilsur plus 40%, 64.52 million. They will pay 60%, 96.6 million. They will keep with them. Now it's asking what is the percentage gain that Garnod will receive if they pay what price was demanded by Pilsur. So if Pilsur demanded 615.6 and they paid 615.6, so see their position. They got a company having a value of 11767.6. Their own value was 480, and they paid not 526.3 million value. They paid premium 615.6. So they were only left with 72. That's 72 out of 161.3, 44%. Okay. And instead of this, I have this working that Garnod will pay 590.82. Okay. And give them 40%, remaining 60%, 96.78, they will keep. If they pay 615.6, that means instead of 590.82, they paid 615.6. They paid 24.78 million more. So their profit was 24.78 million less. Okay, 96.78 million less 24.78 million. That's same as 72 million. Okay, so either the orange or the yellow one, it's your choice. But if they pay more, obviously their profit would go less and they will get 44.64% rather than 60%. Okay, so either they got a value, they deducted their own value and how much they paid, What is the gain left? 72. Or either if they paid more than what they wanted in part B, their profit will reduce by 24.78 million because they paid 24.78 million more. And instead of 96.78, they got 72. Okay. This ends our 9-mark requirement. You can copy this. Okay. Okay, now let's move to the last requirement. It's a 5-mark easy requirement. Discuss the feasibility and effectiveness of the defense strategies suggested to fight a takeover bid for Pilsur. Now, what are the defense strategies to fight a takeover bid for Pilsur? 5 marks coming from here. Pilsur's directors are aware that GARNOD may be interested in acquiring their company. Directors would not welcome a bid for GARNOD as they feel it would result in major changes of how the company operates and threaten their jobs. 2 possible defense strategies have been suggested if GARNOD makes a bid for the company. One is seeking alternative, more welcome bidder for Pilsur. Other is Pilsur making a counter offer to it. So Pilsur board doesn't want GARNOD to make a takeover bid. Why? Not in the interest of the company. They feel it will result in changes in how the company operates, threaten their jobs. So they are thinking 2 different strategies. Number 1, more welcome bidder. Maybe someone else gives offer, so GARNOD goes away. And second, GARNOD is giving offer to acquire you. You give a counter offer to acquire. Okay. Now the requirement is feasibility and effectiveness of the defense strategies suggested to fight a takeover bid. There are 2 strategies, defense strategies in this question. Feasibility and effectiveness. So if I write 2 points each on the effectiveness or feasibility of both strategies, I get 4 marks, 1 more point 5. Okay, so it's very easy. Okay, let's talk about the first defense strategy. Let's see. Let's talk about the first defense strategy. That is more welcome bidder. Pilsur does not want GARNOD to bid because they think this can change companies' way of operation and threaten their jobs. This means they are putting defense like this for their own interests rather than shareholder interest. Okay. Whether they will be able to find another bidder is a question. And secondly, whether other bidder will result in their job security is also a question. So the defense strategy does not seem effective. Okay, are saying, okay, to defend against GARNOD, we will select a more welcoming bidder. Okay, whether this defense strategy is feasible. More welcoming bidder, if you want someone good to bid for shareholders' benefit, then it's fine. But here you are just interested in your jobs because you think GARNOD's way of operation may threaten your jobs. So it is for their personal interest, number one. How they will find a welcoming bidder, that's another question, number two. And third, whether the other welcoming bidder may result in your job security, that is also a question. So under these three questions, I think this may not be a feasible strategy. Okay, but other points are welcome. Okay. Other is counter offer. Effectiveness of this defense strategy. Although counter offer may be considered a good defense strategy against takeover, one thing that needs to be considered is that, see here, revenue and profit of Pilsur is lower than GARNOD, increased competition, and it has failed to develop effectively learning products. Okay, this means it might be facing some cash flow issues. Okay, how it will make a counter offer by taking a loan? Falling revenues and profits will make loan or equity issue a bit problematic, right? So it's just a general discussion. You can write these points. Pilsur, revenue and profits are falling. And for takeover, you need cash or a debt or equity issue. With falling profits and revenue, company may find it difficult to raise finance and do takeover. Similarly, whether Pilsur management is ready for takeover or not is also a question. Whether shareholders will agree to this is also a question. So if everything is in line and agreed by all stakeholders, then it may be a good defense, else not. Okay. So I think for 5 marks, we have written 2, 3 points among each strategy. Okay. I hope things are clear to you, right? So you can copy this question, part C, and we have done all requirements of it. Okay. Hope this is clear to you. This ends our this mergers and acquisitions Mar-Jun 2024 question on Garnod company. Thank you.